Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three tech stocks before they report their quarterly earnings results this week. And those stocks are Lyft, Cisco, and Applied Materials. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to also check out our new Zacks.com/promo page for looking at some of our services, portfolios, and more. So as I mentioned, these three stocks we're going to talk about today are some of the biggest names left in tech that still have not reported their quarterly earnings results during the second quarter earnings season. And the broader tech market has continued to prove pretty largely resilient to all of these economic downturns that are going on amid the coronavirus. And we're going to start with one, though, that might be one of the least immune of these tech stocks we're going to talk about today, and that is Lyft. The company trades under the ticker that's its name, LYFT, and it is the first of these three companies set to release. So they're set to release their second quarter earnings results after the market closes on Wednesday, August 12th, so this upcoming Wednesday. Overall, it's worth remembering that Lyft and Uber have both largely failed to live up to their pre-IPO hype, and the ride-sharing firms both continue to lose money as they compete heavily against each other in a price war. On top of that, they face increased regulatory pushback in the US and elsewhere. And unlike Uber, Lyft has focused more on its core ride-hailing business and not this larger food delivery business that Uber has gone into. And Lyft is more concentrated on North America as Uber tries to kind of expand globally. So at one point, that was a big reason to be more sort of optimistic about Lyft, especially in the near term, that it was not overextending themselves. But then the pandemic hit, and now Uber's food delivery business is really helping them not survive. They're going to continue to survive. They're still making lots of money, but their food business is growing. So if we look, Uber reported their results last week. So amid all of this, their overall revenue was down 29% in the quarter. And if we look, so their mobility revenue, which is i.e. their ride-hailing business, declined 67% year over year in the second quarter. Meanwhile, their delivery revenue grew 103% year over year. So no one's taking Ubers to go anywhere because travel's pretty much halted. There's nowhere to go. There's nowhere to go out, nowhere to go to the airport to. But people are now getting food delivered more than ever before. That business is up 103%, while their ride-hailing business was down 67%. We should also note that Uber announced in early January a $2.65 billion all-stock deal to acquire Postmates. That move is projected to help Uber become the second largest restaurant delivery service in the U.S. by market share, behind DoorDash and ahead of Grubhub. And this comes as pretty much everyone had already been trying to push into that delivery space, but the coronavirus pandemic has certainly made it even more paramount to be in the delivery business more than ever before. And even despite that, Uber still saw its stock fall pretty significantly after its report. So this could put even more pressure on Lyft, who reports on Wednesday. So with this in mind, Lyft stock is up about 34% since the market's lows, which lags the Zacks Tech Industries' 56% climb and Uber's 42% growth. So once again, they're up 34% compared to that broader tech space 56% decline since the market's March lows. Over the last month, Lyft shares have tracked the broader tech space a little bit more closely. Its shares sit around $30 per share on Monday morning, which is about 45% off their 52-week highs. So as all these other tech stocks boom to new highs or well over new highs or right near new highs, Lyft is sitting about 45% off its highs. So theoretically, it does have plenty more room to run, but also depending on how things go, the stock could trend in the other direction. So before we look ahead, I quickly want to just mention their first quarter results to give people a sense of how bad things could get in the second quarter. So last quarter, the first quarter of 2020, their revenue grew about 23%. They still, however, reported a net loss of about $400 million versus a net loss of $1.1 billion in the same period of 2019. And then on an adjusted basis, they reported a loss as well of about 98 million versus an adjusted loss of about 200 million in the first quarter of 2019. So with that in mind, our current estimates are calling for Lyft to see its revenue sink about 62%. So obviously this would be a big drop. They grew last quarter. Uber, we just noted, saw their revenue decline about 30%. So we're calling for about 61% revenue decline to 337 million. And then its bottom line estimate is expected. So it's expected to go from a adjusted loss of 68 cents per share to an adjusted loss of $1.58 per share in the second quarter. So big declines year over year basis is what we're calling for. And then overall, we're expecting about a 27% decline on the top line for the full year, and for its overall adjusted earnings to expand from about $2.87 per share to over $5, a $5 loss. So things were trending in the right direction in terms of them going hopefully more towards that profitability, but the coronavirus has really dampened those plans. And then we should also note that Lyft's earnings revision activity has trended in the wrong direction. With that said, though, they do have a pretty solid history of some big quarterly earnings beats. They've beat by an average of about 37% over the trailing 4 quarters. So maybe a big earnings beat could help the stock, but you never really know. It's a Zacks rank number 3 hold at the moment with F grades for value and momentum. And really, at this point, unless you're just betting on some positive guidance, which is going to be kind of hard at this point, considering that the travel's not really ramping back up just yet, even as the economy slowly reopens. Lyft did say that things were getting better in May, but at this point, I would probably stay away from the stock until at least you see what management says going forward, even though it's still so far off of its highs. And obviously, Uber stock fell, even though its delivery business was booming to help offset its rides business, where Lyft only has its rides business. So that does it for Lyft. And now we're going to move on to Cisco. That trades under the ticker CSCO, and they are set to report also on Wednesday after the closing bell. So that's Wednesday, August 12th. The networking equipment giant sales and earnings are expected to take a bit of a hit, but the stock might offer some investors with other opportunities that they're looking for amid this broader economic uncertainty. So Cisco, their business is big and not booming at the moment, but it's a big business. It's one of the world's largest makers of switches, routers, and other networking equipment that's essential throughout the world. The firm, which is projected to pull in just about $50 billion in revenue this year, topped what was its third quarter estimates last period, and it still provided guidance despite all of this coronavirus uncertainty that saw many huge tech names completely withdraw their outlook. So Cisco, they know they have a better idea of what their business is going to do, even though it's going to take a hit. They know they're expecting that they know how big of a hit it's going to take. So they have more visibility of what they think is going on. Cisco is also transitioning to more software and subscription-based offerings alongside much of that broader tech world. We should also note that their WebEx video conferencing service could continue to gain more traction during what might be an extended remote work period. Their CEO, Chuck Robbins, said in prepared remarks last quarter that we, quote, continued to see strong adoption of our SaaS-based offerings and now have 74% of our software that is subscription versus 65% a year ago. We also believe we are well positioned over the long term to serve our customers and create differentiated value aligned to cloud, 5G, Wi-Fi 6, and more. So with this in mind, looking ahead, our Zacks estimates are calling for Cisco's adjusted Q4 earnings to slip about 11% to 74 cents per share, and about 10% lower sales that would come in at about just over $12 billion. With this in mind, this top line estimate would come in worse than last quarter, where it saw an 8% sales decline, which marked its worst fall in about 6 years. So obviously, last quarter was bad. This quarter is expected to be even worse, but Wall Street has clearly seen this coming since Cisco was able to provide guidance. Meanwhile, the firm if you look down the road, they're expected to benefit as maybe some more countries reevaluate their relationship with Huawei, the Chinese firm that's come under a lot of scrutiny more recently from the US and elsewhere. And we should also note that the company topped our earnings per share estimates by 10% last quarter as part of a pretty impressive run of earnings beats. We should also note that its shares are up about 36% since the March lows, which, just like Lyft, it lags the tech sector's 58% climb. But just like Lyft, unlike many of these other big tech names, Cisco rests about 10% off its 52-week highs, and its valuation is hardly stretched. Cisco is trading at about 16.7 times forward 12-month earnings compared to the tech industry's 27 times. So solid valuation there. And then on top of that, Cisco's dividend yields at about 3% right now. This beats Intel's 2.75%, comes in well above the S&P 500's average of about 1.7%, and crushes the 10-year U.S. Treasury notes, which is about 0.56% at the moment. Cisco is currently Zacks ranked number 3 hold heading into its earnings release, and has some positive growth and momentum scores within our style score system. But nonetheless, playing a stock around earnings is never the safest bet, especially amid all this broader uncertainty. You've seen the NASDAQ slip a little bit in the last several days, so maybe people are taking some more profits out of this broader tech sector, which could hurt Cisco, but it's certainly one worth keeping an eye on, and it also offers dividend and solid valuation amid all of this. So maybe Cisco's one to keep an eye on for the second half. For any interested investors that want to get in on a tech stock that also pays a solid dividend and has a solid value amid all of this run up in value among a lot of the other big names in tech. So we're going to close now with Applied Materials, which trades under the ticker AMAT. It is one of the last big S&P 500 tech names that's left to report, and they are set to report on Thursday, August 13th, so after the bell on this upcoming Thursday. We're going to quickly go over the company. So Applied Materials is a leading semiconductor equipment company that boasts that its materials and engineering solutions are, quote, used to produce virtually every new chip and advanced display in the world. The firm is part of a strong and vital space within the broader chip and semiconductor industry. And this is alongside peers like Lam Research and Taiwan Semiconductor Manufacturing Company, which trades under the ticker TSM, and some other names. AMAT executives really expect to continue to benefit from the expansion of big data, artificial intelligence, all those other buzzwords, which chips are going to play a big role in, and their business is going alongside all of this as they help companies make these chips in different advanced displays. They're also preparing for what's next as the classic Moore's Law's scaling slows. They're focusing on what they call the new playbook for semiconductor design and manufacturing, which they're saying includes 5 elements: new architectures, new devices, 3D structures, new materials, new ways to shrink the feature geometrics, and new ways to connect chips together. So that's their business going forward. They're eyeing what's next. We should note that AMAT did fall short of our second quarter earnings and revenue estimates. Nonetheless, its adjusted earnings came in about 27% higher on 12% higher revenues. And like many firms, Applied Materials didn't provide updated guidance at the time, but they did remain pretty upbeat. Its CEO, Gary Dickerson, said in prepared remarks that based on the visibility we have today, our supply chain is recovering and underlying demand for our semiconductor equipment and services remains robust. So as we mentioned at the top, AMAT stock has been pretty solid. Actually, I don't know if I mentioned that at this point. Now that I haven't, Applied Materials stock is up about 60% since the March 23 lows for the broader market. This roughly matches the tech sector as a whole. And despite this run, the stock rests just below its 52-week highs, which could potentially give it some more room to run for all the reasons we've mentioned earlier. It also is trading at a discount compared to the broader tech space, as it has for much of the past 3 years. It's trading at about 3.4 times forward 12-month sales, versus 4.2 for the broader tech space. And then if we look over the last 5 years, Applied Materials stock has been on a really impressive run. It's up about 260% compared to the tech industry's 100% climb, with a lot of that expansion coming between 2015 and 2018. So maybe Applied Materials could be due for a bit of a breakout at some point in the next year or so. And then if we look ahead, peeking ahead, our Zacks estimates call for Applied Materials adjusted third quarter earnings to jump about 28% to 95 cents per share on 18% stronger sales. Applied Materials currently sports a B grade for value and growth and an A for momentum in our style score system. The company also pays a dividend. Its yield is about 1.4% at the moment, crushes the 10-year U.S. Treasury, not too far behind the S&P 500 average. Interested investors should note that next quarterly dividend is payable on September 10th to shareholders of record on August 20th. So if you buy, you could even buy after they report their earnings and still get in on their next dividend. But like with all three of these stocks, it's certainly probably more prudent just to wait to see what's happening, especially since Applied Materials stock has gone on an impressive run during this March, or the comeback from the market's March lows. But overall, there's certainly three stocks to keep on your radar. There's three of the bigger tech names left to report this week ahead of next week, when we're going to see the likes of Walmart and Target and some of the big retailers report the results. So these are three of the bigger names in tech that should definitely be pay attention to this week. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.